Hi, everybody. This is Dan Sheridan from Sheridan Risk Management. Happy Monday, September 23. And I have two ideas to share with you. One is on a trade that worked well last week and that I put on today. And here is the trade that I put on today and I like is a calendar underneath the market. So we're currently at 57.16, and we're going to look at a calendar trade. A calendar trade is simply a mixed month spread. I'm buying a farther out expiration, Oct 16, selling it closer in October 11th, and the same strike. A diagonal would be different expirations, different strikes. So I'm placing the 56.90 puts the strike below where we're currently at 57.16. So we're at 56.90. So the question is, why would I place a calendar, in this case, 26 points under the market? There's two reasons. Number one, we're near all-time highs. I'd like a little more room on the downside as I'm constructing a trade. Number two, even when you put a calendar underneath the market, your delta is going to be pretty neutral. So I'm getting a head start to the downside without committing the deltas. And realistically, when you're on a $5,000 vehicle like SPX, 20 points is nothing. I mean, the 56.90 put calendar is the same amount as the 57.15, right at the money. So you're not getting a discount by going out of the money because on the downside, things go down faster. So I like this. And so if I look at this trade for managing it, where I would adjust it here, I'll be out near this, the break evens 57.70, 57.80, we'd be past the all-time highs. And on the downside, my adjustments would be down 56.20. But what's interesting, folks, what's interesting on this thing is that if you said, well, explain to me a little more about this trade. Well, it's Oct 11, so this thing is this trade is a 18-day calendar. My shorts are 18 days out. My longs are 23 days out. So map this out, Dan. What's this trade going to look like? I'm looking to be in it till Friday, about 25% of the duration of the short. So if you look at, so we can put a little legs to this, the expected move or one standard deviation to Friday is about 60 points. So what does that mean? So I can put a roadmap here. I can say 56.30 on the downside. Excuse me, that's not right. The current price is 57.16. 60 points on the downside would get us to about 56.55, right? So 56.55. And then the upside, if we add 60, 57.75. Dan, what does this mean? What you're going over? So for this trade that I put on this calendar, this 17 or so day calendar under the market, it's saying the SPX, there's a 68% probability on Friday. I actually bought 3 more of those calendars at the same price. All right, there's a 68% probability we're going to be between 56.55 and 57.75. 68%. So are we probably going to get to an adjustment on the downside? No, right? We could. Could we be getting to an adjustment on the upside, the break even? We could. And if we went up, right, what would I do? If we went up to this 57.80 level, I would add a calendar. I'm going to show you a little trick here. If we got up to 57.80, I'd add a calendar in the calls at the 58.10s. But I do something a little bit different. I would do it only 3 wide. instead of the same width of the original calendar. Why? It's a ton cheaper, and I can reduce my my short delta exposure when I get up there. So a few ideas. So this is how I kind of look at trades. Once I get a trade, when you look at through the lens of the expected move, and then you can kind of map the whole trade out and keep it very simple, simpler. Anyways, so that's what I'm looking at. And you can see here, I think I just did, I did a few more of those. So I did that calendar 56.90. I bought one at 580. Then I bought three more at 570. A lot of times I scale into them. As the market's going higher, I can get a better price. All right, anyways. So that's what one of the things I'm looking at today, and the market's still going up, which, short term it is. I mean, that's the market's a little happy now. But still, as I'm structuring trades, I still want them near neutral, but a little more room on the downside. All right, that's the calendar. And then real quick, I'm hoping to have by this coming Friday my class on all wheel strategy. Many of you seen the wheel strategy, but just do it with options. And most of you have, when you're looking at an all wheel, most of you know the usual dance of an all wheel strategy. Right? And the usual dance of an all wheel strategy is you sell a put, and you do that for monthly income, and you're excited, and you just bring in cash every month. If the put goes down, you get assigned on the put, then you're long stock. As the stock goes up, you're going to sell calls against it. And this is all a bullish scenario. Eventually, as it goes higher, you could get assigned on the short calls. That'll negate your long stock. What you'll get, you sell puts, you get assigned on the short puts. Then you get long stock. As it goes up, you sell calls. As the market goes higher and higher, obviously you could roll the calls or do something. And eventually you get assigned on the short calls. And that takes you out of the long stock. And then you do this whole process again. You kind of start over and you sell puts, right? That's the conventional wheel strategy. And what I'm looking at is to this course, and I'll let you know when this should be done, but because you can see when you're selling, I'll just give you a little bit of this. When you're selling a cash secured put, which looks like a covered right, and if I sell a put, maybe a 17 delta put, about 25 days out in Microsoft's at 433, I sell a 415 put for $2.20, but I've got to put up 41 grand, right? To sell the put. That's a lot. So you're making $220 divided by 40 grand. That's not a great deal, right? So if you do something like you sell a 415 put, maybe a 17 delta, 25 days out, if I go buy the 390 put, 25 points lower, now I'm doing a put credit spread for $1.65 credit. Well, instead of making scenario one, $220 divided by 40, let's just say $40,000. Scenario two, I'm bringing in less, $1.65 credit for 165, but this is a vertical spread. So my width is 25. right? So I have $2,500 of on this $2,500 on this trade is my risk, less a credit of 165, or what is that, about $2,340? I'm kind of winging it, right? So would you rather make 165 versus 2,340 or 220 on 40 grand? So what I'm going to go through is every step of the wheel, show you how I would do it, and walk through the whole wheel. And I should have a course on that. Hopefully it'll be a help to you. And the main reason this all wheel option strategy, some of the advantages over the conventional wheel strategy is you're putting up much less capital, much higher yield potential you have here, because you don't have to deal with stock. And we'll go through some of the nuances about it. So those are a couple things on my mind for today. Have a wonderful day, everybody. We'll talk to you next time. Thanks.